Hello everyone, welcome back for our quarterly catch up with David Bassanese, Chief Economist at Betashares. I'm Jason Petersen, Managing Partner at Five Financial. Welcome David.
Great to be with you, Jason.
David, a lot's happened since our last meeting back in February, to say the least. We've had the Liberation Day fallout and obviously the tariff wars going on. How would you best summarise markets over the past 3 months?
Well, it still is all about the tariffs. I mean, we ended February with the markets just starting to weaken on the back of, more and more talk from Donald Trump about tariffs. Then we did get the, famous April 2 Liberation Day announcements. The tariffs were a lot larger and more extensive than anyone expected. Many quickly concluded, economists, if he were to impose those tariffs, probably would cause a US recession or a good chance of it. Markets then, nosedive for a few days. They actually bottomed around April 8, and we've had a V-shaped recovery since on the hopes that he will back down on the tariffs and not push the economy over the brink. So yeah, it's been a very tumultuous few months, very sharp decline in the first period and then a very sharp rebound. So net, you've had virtually, very small changes in the equity market.
Little change, isn't it? Little change.
Over the whole period, yeah.
And I think if you look over 12 months, we're still, we're doing quite well.
Yeah, exactly. We're still up on year-ago levels, yeah.
Despite this, yeah, really fascinating. What do you see as the key market issues going forward?
Yeah, well, still Trump and the tariffs. I mean, look, we've made a judgment at the committee since the start of the year that, ultimately, Donald Trump doesn't want to cause a recession. And if it looks as if some of his policies risk that, he will pull back. And so far, it's been a white knuckle ride, but so far that judgment is holding up in that he has pulled back at the 11th hour. So that is still the key issue, is that will he maybe do some trade deals, but ultimately the tariff increases across the board are relatively low. But most importantly for businesses, the uncertainty of what they will be is hopefully in the rear vision mirror pretty quickly, because it's the uncertainty is almost as bad as the tariff levels themselves. So that's one big issue. Look, another sort of looming issue at the moment is the US debt issue concerns. US budget deficit is still quite wide. They've passed a tax cut bill recently that added to the deficit. There's been some murmurs in the bond market. Bond yields have ticked up a little bit on the back of it. So there's along with tariffs, a concern that maybe bond markets react negatively eventually to the US debt outlook, which is not getting any better. But still, again, our judgment is that won't happen. And if it were to happen, the Fed could actually intervene and start buying bonds and keep a lid on bond yields. But that's another risk factor at the moment we're keeping a close watch on.
In terms of inflation, so I think last week the numbers weren't looking too good. So what's the implications, particularly around domestically as well?
Yep.
Australia interest rates. Obviously, we had the cut last month.
Yeah, so I mean, the good news is that the RBA did cut rates over the past 3 months at the May meeting, following the what was a good December quarter CPI. And showed that underlying rate, dropping into the target band. The March quarter CPI, I should say, which was in line with our expectations. Everything's sort of playing out well. We did get a monthly update on the CPI, which is what came out last week, but April, it just showed the underlying measure of inflation ticking up from 2.7 to 2.8. Not bad, but as not in the direction we want it to go. Ultimately, at the moment, the RBA is expecting that number to go to 2.6 by the June quarter, which I still think is possible. And if they do get it, they can still cut rates in August. So we've still got our base case is still 2 more rate cuts on the back of continued declines in inflation. The monthly numbers are more volatile than the quarterly numbers. You take them with a grain of salt, and that's why we do think the RBA will wait to see what the quarterly numbers tell us, more so than the monthly ones.
So you're thinking July cuts off the table?
At the moment, I don't see the hurry for the RBA to do that. Again, the monthly inflation numbers can be volatile, and so I think, particularly given the the slight uptick that we got in April, that they can wait for the actual quarterly outcome that comes in late July, and then assuming that's good, they can move in August.
All right, so let's have a think about, we just had the quarterly rebalance. The investment committee met. No dramatic changes, but I note there's a bit of an uptick in infrastructure
Yep.
There's one at the expense of global currency hedged
Yeah,
exposure.
we've made a couple of changes. Firstly, look, we're still overweight growth assets versus defensive, so equities versus cash and bonds. We've scaled that back a little bit. So again, in terms of our framework, we're modestly overweight. We're not as overweight as we can go in the models, so we're cautiously overweight. We've pruned that a little bit, just given the uncertainty, particularly around Donald Trump and those tariff issues. We are hopeful that he will pull back, but there is a risk that he may not. And just to add to I guess some defensive element to the portfolio, shifting some of that overweight from global equities to global infrastructure. And why? Because infrastructure does tend to hold up a little bit better in an equity market sell-off. So again, it's just adding a little bit more defensive positioning within the growth assets. Within defensive, we still have an overweight to gold. Even if things don't go too badly, I think gold, what we're seeing is central banks around the world diversifying the reserve holdings. They're going to continue to be buyers of gold in good or bad market outcomes, we think, over the next little while. So that bodes well for gold. And if things do go pear-shaped, hopefully not, you may find gold doing even better because it'll be a safe haven trade.
So how does that impact the US dollar? Is that so? Countries around the world buying gold as a reserve as opposed to USD. Is that having an impact on the US dollar?
The US dollar, it's fair to say, has weakened this year. I mean, the US dollar is very expensive from a long run perspective. That's incidentally why we like hedged global equities, because we think, can't pick it exactly, but over the next couple of years, we think the Aussie dollar's likely to rise rather than fall. US dollar likely to come down because it's very expensive. But I think I think central banks, particularly emerging markets, are basically thinking, we've got a lot of US treasuries, got a lot of US dollars as reserve assets, and we want to diversify away, not be so reliant on those assets and hold some gold. Seems to be the trend. They're central bank buying of gold has doubled over the last few years relative to what it normally is. And we think that's going to be an ongoing structural feature favouring gold for a while.
Just coming back to your Aussie dollar appreciating versus you, is that more strength in the Aussie or weakening in the US?
Look, a bit of both. A bit of both. I mean, look, at the end of the day, if you look at the Aussie dollar against the US dollar, the bilateral rate, it broadly moves in line with the strength of the US dollar against major currencies around the world. So Aussie dollar, we think it's about the RBA and it's about commodity prices. It is at the margin, but the big driver of the Aussie, particularly against the US dollar, is just what the US dollar is doing against the yen, the euro, the renminbi. So if you think broadly the US dollar is expensive and is going to weaken against those currencies, it's going to tend to push up the Aussie.
This time around, David, we've asked our clients to field some questions to us. So I've got a couple. I've only got a couple at this point, which really good questions actually. One of them, and I'm going to name names, but I won't name surnames. It's Surin. So thank you, Surin. Any response to the prophets of doom? Those warning of the USD collapse, depression in the US, the prudence of buying gold, which you spoke about, the effects of drought, taxing of super. In fact, anything negative. So the cause is retiree. So we've got a lot of pre-retirees, a lot of retiree clients. What causes them to experience anxiety? And interestingly enough, so I'm just going to circle back to your outlook and the fact that we're still overweight, slightly overweight growth, certainly doesn't subscribe to the prophets of doom theory. But anyway.
Look, there's an old adage, markets climb a wall of worry. So equity markets, when they're rallying, it's, they're always different things to worry about. Not to say, problems do come around every now and again, no question. But generally speaking, 8 times out of 10, the things we worry about don't turn up being as bad as we feared. Secondly, if it leads, it bleeds. And I used to work at the Financial Review many years ago and used to write a column, and it was always, I found that my column was often downplaying what was on the front page because often it's negative news that attracts the eyeballs. And so there is that bias in terms of psychology that to an extent, people that write blogs, people that write newspapers and magazines tend to focus on the negative things. So you've just got to be aware of that bias. Look, I don't deny that there are risks out there, but there are always certain risks. And again, our judgment ultimately is at this stage, Donald Trump won't be crazy enough to make tariffs cause a US recession. He'll pay for it with the midterm elections next year, or the Republicans could lose their majority if they were to do that. And he could actually face impeachment if the Democrats get back in with a congressional majority. We watch these things very, very carefully, and we're focused on risk, particularly of a US recession at the moment. They're a little bit more elevated than normal given what's going on, but certainly not our base case at the moment.
Yeah. The other one, and from another client, is Bernie, and this is really interesting. There's some really fascinating things to talk about here. The retirement window can be 20 to 35 years for baby boomers. What strategies can be put in place to ensure we're not crystallising market volatility when drawing down a pension? When do we expect the retirement income stream products like annuities to become mainstream as well? So really interesting. I met with some of the team recently, and I saw you've just put out the bond ETFs with fixed maturity dates, which is just brilliant. So I think that's a call to what people want, and what we as advisors and what we want for our clients. Something that gives that fixed term nature of income, certainty of cap to a large degree, certainty of capital. To answer that question from our perspective, there are these things coming out. Can you talk a little bit about those, perhaps?
So,
broadly?
Like bonds are usually a great defensive investment. If things go badly in the global economy, interest rates fall, bond yields typically fall, and the return on bonds goes up as a result. Thing about a fixed rate bond index, though, is you're never quite sure what the capital value of it will be when you eventually need to sell them and get your money back, because the value can vary in line with interest rates. So the thing about what we've introduced now is these defined income bonds, is they have a certain target date. So you buy them, and with, say, a 3-year or 5-year, it's effectively like buying a 3-year bond or a 5-year bond. And so you get the income stream, when you at the yield that you get when you buy that bond is the yield you'll get over that period. And, subject to, governments not defaulting on their bonds or corporate bonds defaulting in a major way, which is a very, very tiny chance in Australia, you're more or less, going to get the par value of the bond or the nominal value of that bond back at the end of 3 years. So it provides relatively more capital security or capital certainty, as distinct from a typical fixed rate bond investment.
And that's really interesting. So from our perspective, we look at, and we've looked at this time immemorial, looking at what we call bucketing strategies. So we basically set aside a bucket of money, very defensive, that's going to serve the client over the next 2, 3, even 4 years of their income needs. So we never actually have to sell down growth asset when markets are actually falling. Now, that's got its own issues in terms of cost efficiency in doing that. But with the products like this, we can now actually build these things out with a lot more granularity. So as a client, if you're looking at that part of your portfolio, you can see it's very, very, very stable. So for the next 3, 4 years, whilst you need that money, it's there. You know exactly what it's going to look like, and you know for a fact that you never have to sell down growth assets, particularly when we've had a 9% decline, I think it was, back in February, March. So
it gives you great peace of mind in that sense, is that you've got the income there that you need it to tide you over some volatile periods, and it makes people generally more comfortable than holding the growth assets, which do power the returns over the longer run. So it's a good strategy to make people more comfortable, ultimately still holding some of those growth assets.
And obviously making sure over the long term we're all living longer, hopefully, all of us. It's that longevity risk. So we still need the exposure to those growth assets. So really, really important. Otherwise, unfortunately, your standard of living is going to decline dramatically in later years if you don't have that growth. So really important. This gives us the ability to do that. David, one last thing. I was actually, funnily enough, my daughter was cooking dinner last night, and she was making tacos. And she said, "Dad, I've heard something about Donald Trump and tacos." Oh my goodness! Well, tell me, David, what's a taco thing?
We're kind of relying on the taco trade here. Actually, it's come about in the last few weeks. Actually, it's Trump always chickens out. So when it comes to tariffs, is the idea he talks big, but if markets have a negative reaction or it looks like being a risk to the economy, he'll chicken out and pull back on the tariff front. So it's sort of another term doing the rounds at the moment in markets, the old taco trade.
Just doesn't help with volatility.
That's right.
David, once again,
worries. Thank you
very much. It's been great.
Great to be with you.
Thanks. Cheers.